Peter Rose, Longwood Currency Trading. Good morning. It's a cold January morning this morning, and this will be an interesting video because I'm going to be discussing regression to the mean analysis for Forex trading, a topic that is pretty dry and dull, but sort of important that you at least have an idea of what the principles are behind it so that you can look at a chart and determine whether that might be an opportunity for a trade or an opportunity for a cup of coffee, which is what I'm going to get right now, a cup of coffee. All right, got the coffee ready. We just have to finish a little cream for it, and then we'll be ready to get into not some whiteboard stuff. I hate that, but there'll be some slides to go with this to give you an idea of what's going on. But for right now, hold with me for just a second while I take care of this business. Okay, so coffee in hand, ready to go. Let's go in the library and get on with it. So one of the phenomena of trading is that of price reversion to the mean, where after a series of large and fast price movements, price will return to its underlying moving average line. That's the mean. The moving average is the mean, or the average. And so, for example, if price were to decline very quickly, it would take time for the moving average to reflect that change, because most you have a 21 period moving average or a 15 period or whatever that moving average is. It's lagging behind the current price by 15. So at some point, however, that that price movement would start to slow and exhaust, and it would either start to roll up again at the declining price, start to roll up, and the moving average price would connect at some point. So you'd get a convergence of price and moving average again to its normal state. That's the crux of the whole thing. So I'm going to pop up a slide here for you, and it's figure number 1. As price moves normally, in other words, just a general increase or decrease, whatever it's doing, the moving average line tracks this movement, but it's obviously delayed and is flatter, and it's flatter based on the period of that moving average. So here's a picture of a moving average on it's actually a Euro USD thing, and you can notice that the price is bobbing up and down, but the moving average it's a 21 period moving average, simple moving average, and it's just kind of tracking that price relatively straight as it goes through the normal price movements. Now, if you look at the next slide that we're going to put up, if price begins to move down faster, then it will take time for the moving average to catch up. So you can see here that price is accelerating in a downward movement, and the gap between where the price is and where the moving average is gets larger because the average hasn't had a chance yet to catch up with that line. And in fact, at some point it does catch up with the line. We're going to go off into the third picture here, and so that's the two things that are occurring. The price is stopping that downward movement. It could be an upward movement too, but in this example it's a downward movement. So that stops, and it starts to move sideways, and in fact starts to go back up. And in fact, you can see the moving average itself has begun to drop down and to catch the tip of that movement. So that was, the three kind of stages of a regression process of price. They say that price is regressing to the mean, but it's also kind of the moving average line that appears to be catching up. It's not that the moving average line catches up, it's just that because that moving average is a reflection of what the price is doing, right? So it's actually the price that's reverting back up to the mean, or reverting down to the mean, wherever that is. Well, let's take a look at another figure, figure number 4. And you're going to see that there are several of these regression events. And in this instance, we're looking at a 15-minute Euro USD chart with a 21-period moving average in black there. And as you can see, the far left gap, we'll call them a gap where there's a reversion. That's the one that we just did the three past figures in. You'll notice then that the rising price, the moving average begins to track that. You have a very sharp decline. Obviously, the moving average hasn't had a chance to even change as a result of that. But then you do have another regression event. There's a recovery. There's another small regression event. There's a recovery as price moves up. Another small regression event followed by another regression event followed by a rising price regression event. So again, this is a 15-minute chart, and so therefore there are an awful lot of these things happening. They happen all the time. And so when we're looking at this sort of stuff, we have to have some criteria in order to use this in trading. There's some concerns that we would need, for example, to do that. All right, so that it's easy to look in hindsight and say, oh, there's a regression thing there, and I'm going to blah 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 blah. Well, there's some concerns, or there's some issues. There's always issues, right? What time frame chart are you going to use? What moving average periodicity will you use? Should the moving average be a simple moving average or an exponential moving average? Is there any correlation between the chart time frame and the moving average periodicity that you should use? What criteria will you use to identify an appropriately sized extended price movement, that gap? How do you calculate the expected size of the gap to determine that the price move has extended too far? How do you define when price is slowing so that you can enter your order? And at what regression level will you close the trade at? Those are concerns. Those are issues that each one of those issues has one of two solutions. You can either resolve it intuitively, or you can do it mathematically. And my position is, look, if you can't find a mathematical solution to describe a process, a physical process, whether that be not so physical as a price movement or a falling tree, which is very physical, if you can't describe that mathematically, then you really are talking about spiritual, emotional, sort of stuff, and that's hope, fear, greed. You don't base trades on that. You have to base your trading decisions on concrete things, and mathematics describes all concrete things. The laws of physics describe these concrete things, whether they're financial or whether they're physical in nature. Now, I'm using the term, just to be clear a little bit here in this video, and by the way, I did a blog post on this of the same name that you may want to take a look at, because it's going to go into the mathematical background behind regression to the mean, whereas in this video, I'm going to be talking more about the intuitive side of it. So you might want to check out both so you get both slants to it. But from a technical standpoint, there are two terms that are used. One is regression to the mean, and the other, used by the financial folks, is called mean reversion. Reversion and regression are basically synonymous, but the two terms themselves, regression to the mean and mean reversion, represent different things, and they are mathematically calculated differently. And I give the definitions and how those calculations are done on the blog post. I'm not going to get into it here. But the mean reversion is used by financial folks to describe the event that. So after that discussion of looking at that chart, okay, that's a cherry-picked chart. That's no question about it. But it did throw up. Let me see. I'm going to look at the chart again here. I got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. There are 11, in hindsight, regression to the mean events that occurred on that 15-minute chart. And they're all different. They all have different characteristics, but they all end up, in hindsight, being regression to the mean events. Could you identify those in real time? Well, that's the trick. That's the intuitive part of it. So now look back at all of those questions that I asked before, and I'm gonna put that slide back up now. Look at the questions that are there, or the issues, what we call the issues. You know, it's complicated as far as the question itself. What time frame chart will you use? Doesn't really make any fucking difference, you know. Look down there. There's one of them that says, "What criteria will you use to identify an appropriately sized extended price movement?" Well, you can see from the chart that there is no criteria. You could form a relationship between the increased size of the candles and the number of candles. You could write some kind of an equation that would give you some sort of mathematical feeling as that, oh wait, this event is occurring. This could be creating a regression to the mean event. In fact, you can program a computer in order to recognize that particular series of events. Well, how many candles are you going to have to check for? You know, that sort of thing. And then it doesn't take into consideration the spread or the ATR or anything else. So look at each one of these questions again. Look at them, and see that they are, though it may be possible to resolve, not solve, but resolve the answer to them mathematically or theoretically. It's why? Why bother? You simply need to be aware of what the issues are, and those are all issues, so that when you're watching this stuff in real time, you can be asking yourself that, and through a process of experience, again, we get back to the experience of asking yourself these questions as you're looking at price action as it splatters itself across your chart, that you will be using your intuition in order to not find solutions to these questions or solutions to these issues, but rather whether these are being displayed on the chart, and the display of these questions indicates a potential regression to the mean event. So just a kind of a cursory analysis of regression to the mean for you. As a don't look for this stuff, but if you look for regression to the mean events, you're going to find them. You will, and you'll be wrong. You simply have them as a tool in your toolbox, so that as you're watching price action, you'll go, oh, I recognize that. I've got a tool to solve that. We identified on that overall chart. Remember that pin bar we talked about? That's another tool in your toolbox. If you look for pin bars, you'll find them, and they won't be correct. But if you are looking at price action that moves toward a pin bar event like that, you're going to say that could be a valid pin bar. And in fact, in that particular instance, it was. And there was something like a 20 pip profit that could have been had on that particular 15-minute time frame. And again, if you extrapolate that up onto a daily, it could have been a 60 pip event on the Euro USD that's there. You know, you might have a daily ATR of 100 pips, or like on the pound dollar ATR right now, it's 130 pips a daily ATR because of some of the volatility that's going on in the markets right now. So, and those volatilities on the major pairs, particularly the pound dollar, Euro USD, you know, those comprise a huge majority of the overall $6.6 trillion economic impact that the currency market displays, because there's so much commerce between those particular economies. You'll find that because of that, that the ATRs on the daily side are very large. In fact, they're outsized. A normal ATR, what's normal, on GBP USD, for example, has been about 80 pips over the last maybe few months that we've been looking at this stuff. The ATR on the 5-minute chart that I trade been about 5 pips for a long period of time. And I did a trade the other day and I got clipped really bad, and I'm stuck in the trade right now. I had to do a carry trade because I wasn't paying attention, and all of a sudden I find out that I'm not dealing with a 5-period ATR. I'm dealing with a 10-period ATR on a 5-minute chart. I mean, that just screws up the entire thought process of the reason that I put the trade on. And so I've now done some staging into that trade using a totally different approach. I'm no longer scalping. I'm no longer day trading on the thing. I've turned it into a long-term trade. I've involved my entire account size instead of the small part of it that I was trading with before, because the characteristics of the whole thing changed. While I was sitting around sleeping at that thing, I've been just trading watching this every day, and didn't really recognize the ATR of that 5-minute chart because they were all proportional, so they all look the same. One of the things that I usually do in trading on a daily basis is throw the ATR up on the chart before I start trading, just to make sure that I'm dealing with the same set of rules that I should be. That's where people get caught in their systems. I've done, I think this will be my 64th or 5th or 6th or 7th video or something that I've done. And all through all those videos, in the periods that I've been trading and looking at charts and stuff, on pound dollar charts, the 5-minute ATR has been 5. The 5-minute ATR has been 5 pips, and so I'm talking about this hard 8-pip stop and all that stuff. Well, as soon as the ATR goes from 5 to 10, that 8-pip stop is ridiculous. It's useless. If the ATR is doubled from 5 to 10, I've got to double my hard stop from 8 to 16 or 20. So it changes the characteristic. If I get a 20-pip stop, I'm not doing day trading anymore. With an ATR increase to 10 pips, I've got to move up in time frame and trade off of the 15. And I might manage the trade on the 5-minute or where I would normally manage on the 1-minute or 5-second. I can manage on the 1-minute time, but those ATR changes radically affect everything. And this regression to the mean stuff, it all changes dramatically when the base ATR changes, and then all of a sudden you see a large ATR go through. You're not looking at the same potential profit event from a regression to the mean process that you would if you were paying attention to what those ATRs were. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.